Will we see 1970s and 80s inflation by the end of this year?
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Don't say I didn't warn you. The possibility of a 1970s-style inflation in America in the year 2021 is increasingly looking like a reality. So begins Trish Regan in a recent post in American Consequences. Consequences. It is somewhat preposterous to believe that there are going to be no economic repercussions when the money supply has been increased by over 24% in just a single year, a figure that many experts expect to climb to 40% by the end of 2021. Inflation occurs when your purchasing power decreases and the costs of goods and services rise. So, how could inflation affect the older homeowner and reverse mortgage lenders? First, when the Treasury yields increase, secondary market investors who do purchase mortgage-backed securities, or MBSs, will be demanding higher rates. Why is that? Because they want compensation for the increased risk. When Treasury yields drop, we see lower rates on mortgages, which has in fact propped up or stimulated the housing market and real estate, as we can see in the pricing today. Now, low rates have given us a temporary respite or a bright spot in the U.S. economy and, of course, have driven a record number of reverse mortgage refinances in the last 6 months, which we've seen in case number assignments. The second reason is since adjustable rate HECMs are using a one-year CMT, or constant maturity treasury rate index, when true inflation emerges, rates will climb and reduce the borrower's principal limit factor, or PLF, that is, the available loan proceeds. Now, while the government's cost of borrowing money is historically low right now, it is certain to increase. Until we have the secured overnight finance rate, or SOFR, approved for adjustable rate HECMs, domestic rates will prevail with the CMT. Now, last week, mortgage rates actually surged as Treasury yields increased to their highest level since March 2020. That's when the coronavirus pandemic hit the U.S. And the third impact of inflation is when the cost of goods and services do increase. Homeowners that are on a fixed income are going to need to reduce their expenses or find alternate sources of cash flow. In the meantime, economic concerns and low rates have heightened interest in the reverse mortgage. In fact, we interviewed Melinda Opperman with Credit.org for this week's recent podcast. Be sure to listen to that, by the way. And she confirms that there has been a notable increase in counseling sessions, and many are citing they have a reduction in monthly income, or they're refinancing their HECM for more cash, or it's a family member they're trying to help who has suffered a job loss. Nearly every borrower in their counseling session has mentioned COVID-19. While the Federal Reserve is confident they can prevent an inflationary spike, history has taught us that reality often interjects itself even into the best laid plans by economists and the Fed. For example, today it takes $6.74 to purchase what $1 did in 1970. 4 years later, inflation exceeded 11% in the final years of the Vietnam War. Now, prior to a spike in inflation, consumers may take the buy it now rather than later approach because they see the value of their dollars in decline. But unfortunately, that could lead to an urge to spend quickly and create an inflationary loop, and the economy could find itself with excess cash that no one wants. Closer to home, inflation increases the cost of borrowing, of course, for those that will be seeking a reverse mortgage, both accelerating the growth of the loan balance or negative amortization, but also any unused portion of the line of credit or principal limit. However, not all are convinced that the specter of inflation looms ahead. Carl Weinberg, chief economist at High Frequency Economics, told CNBC that expectations of inflation are detached from reality. However, in the market's perception is reality, as we know, and Weinberg added this: we are going to see as much as 2.75 percentage points added to the headline increases in the CPI. Now, that's the Consumer Price Index for inflation. Headline inflation rates in the eyes of people will be influencing their opinion about that. Now, increases in the CPI are not inflation, he argues, and this is not inflation, but with food and energy prices boosting the CPI significantly, consumers are going to blame inflation. In the meantime, reverse mortgage lenders find themselves in a most opportune moment as home values continue to appreciate against the backdrop of astonishing low interest rates. Now, what are your thoughts? Do you think that we're going to see inflation by the end of 2021 or early 2022? If you disagree, tell me why in the comments section below. And be sure to share this video with others. You can do that by using the social media links on this page. Thanks as always for watching, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECM World.